Hello everyone, welcome to the Grow Your Future podcast. This is the final episode of 2022. I am your host, Zah and I'm joined by Sam, the accountant.
Oh, just the truth today. No burns, that could be a burn, but accountant.
Don't worry, it's coming, Sam. It's coming.
I'm waiting for it.
The final one is coming for 2022, the final burn.
We're through this podcast.
It will happen.
Okay.
Get ready.
I'll brace myself.
How are you, Sam?
Good, man. Good.
How was Christmas?
How was Christmas?
Obviously, you're very happy.
I ate a lot of chicken. I bought a steak in an El Jana franchise. So eating the profits, man.
Eating the profits.
No,
getting higher in your own supply.
That's it. Get wholesale costs, man. I don't pay retail, so it's all good. No, Christmas was good. Spent with family, all that kind of jazz.
You got to do it.
It was a good break. Good break.
You got to do it.
You?
Yeah, great.
How was your trip?
Great. My trip?
Yeah. Didn't you go overseas?
No, that was ages ago. Well, we went up to Central Coast, seeing family.
I see.
Yeah, and now we're sort of preparing for another overseas trip. Mm-hmm. So hope everyone enjoyed their Christmas. And what we want to do is sort of wrap up 2022 and also come out with our 2023 forecasts.
Indeed. Exciting times. The changing of the guard, the new year. This is the time where everyone should reflect. They should reflect more often, but reflect on what they've done and what they stuffed up, what they did good at, and maybe tweak a few things for the next year. So it's always it's sort of a typical thing to do, but you should.
Well, I think at end of year is the best time to really sort of look back and go, hey, this is what I've done. Did I hit my targets? Like, most of our listeners and our clients, for example, they've got big goals and targets, and sometimes they're yearly targets or 6-month targets, whatever it is. See, how far you've come. Note down the mistakes and the failures that you've made throughout the year, and also take the time to write down new goals for next year. A lot of people sort of bag out people who write down goals, and I think it's more so because a lot of people don't stick to them. But if you're always working towards something, I think that's really important.
Gives you direction.
Yeah,
you need direction. We've talked about it before, but you need something to guide where you're going. Otherwise, you're not going anywhere.
Yeah.
So it's a good time to reflect. Maybe make those new goals for the next year. I think also important, don't just think next year. Think like further ahead, 3 years, 5 years. People say they overestimate what they can do in 1 year, underestimate what they can do in 5. So
I think it's a balance between the two, Sam.
Sort of, yeah.
I think if people get too focused on, the 10, 20-year goal, what will happen is they get overwhelmed and they just sort of like don't do anything, right? But then if they don't have that bigger picture in mind, it's hard to pull them through those sort of small fluctuations of what you have throughout life. So I think it's important to have short-term goals, medium-term goals, and long-term goals. I consider yearly goals as short-term, because obviously being in property, we're always looking over the long term, minimum 10, 15 years, right? Yep. So, what we do in a year is a very small fraction to the overall journey. But it's also really important to reflect on what you've actually done. And, some people haven't bought property, they've just saved more, or they've paid off bad debt. Whatever position you're in, it's really important to take note of it. Pat yourself on the back, reward yourself at this time of the year, put your feet up, and then look to next year for bigger and better things.
Hopefully to improve, 100%.
So what we wanted to talk about today was we wanted to start off with some examples of what we had done for clients for 2022, right? And we're just going to take one example for a house and land, one for townhouses, and one for apartments. We had some really, really successful stories, and we'll start off with the house and land, right? This house and land we did in Bridgeman Downs, which is a northern suburb of Brisbane. Yep. We bought the block for our client. There's a couple in that same estate at around I think it was about 500 grand for the land. The build came in at about 450, so they were double-story homes. They were specced up. They had ducted aircon. 900 appliances, 2,700 high ceilings, like all of the upgrades, right? Big 5-bedroom homes, 280 odd squares internally.
Big
yeah,
places.
big places. These things will rent for like $1,000 a week.
Wow.
So really good yields. Total cost on that was about $960. If they are actually coming up to completion now. If we were to replace that same piece of stock with the same build in the same location, we wouldn't be able to do it under 1.3 million.
Wow.
So, like, let's say comfortably, say a couple of $100,000 in that particular asset type. Took a little bit longer than we'd normally take for a house and land, given the construction crisis we're in at the moment. But they're on the back end. We're probably looking at a, February handover, and then they'll start getting a 5% rental return on that. So that was a really, really big win for our clients.
And that's not a conventional investment property, would you say, across the board, that price point. But you can really see when you look at those numbers you were saying, the $1,000 a week rent, which is 5%, and that equity gain when it's complete, why it should really be a more prominent investment.
Well, I think the
strategy.
issue that we've got now is servicing, right? So a lot of people don't have $1 million to spend on a house and land, but if you've got the capability, we'll always push you into that bracket if we can. We don't really want to spend any more than $1 million because then the yields start to drop. But that was just really good timing. We locked up the dirt at a really good time. We locked in the builders at a good time as well. To replace that now, you're going much further out. So Bridgeman Downs is I think it's like 9 Ks from the CBD. Now you're probably looking at 20 Ks from the CBD.
For that same price point.
For that same price point, yeah.
Wow.
So you can see that the prices have moved and it's being pushed out. The rents are still strong in those locations. So there's still opportunity in that price point. We're doing some now, which are about 20 Ks from the CBD. I'm actually doing one myself personally. And that's just the way it is, right? Like as the market moves, you have to step back out of the CBD or out of that blue chip location to achieve that same price point and that same result.
And just tracking back to when these were being conjured up in the investment space with your clients, can you tell us what type of typical client would be jumping into that? Just the basics of their situation.
These particular clients already have investments. So, they've got, 3 or 4 properties already, maybe priced around that $500,000-$600,000 mark. They've built a bit of equity in it. They've refinanced, they've pulled that equity out, and they've used that as maybe a 20% deposit towards the $1 million play. So, they've quite easily taken that $200,000 and put it into that Bridgeman Downs property, which, to do it as your first investment, it's a bit of a stretch, right? Most people spend, $1 million on their first home. So it's not conventional. It's definitely for the more advanced, or maybe the high income earner who has quite a bit of capital behind them. So it's not for everyone. But look, as you can see, the more money you spend and, the bigger risk you take, but it can be highly rewarding.
More money. No, it's good just so listeners out there, they can maybe see where those initial investments you do that aren't at the million, where you can work towards. And you can still achieve probably bigger returns than those smaller investments anyway. Yeah,
well, I guess it comes down to the individual, right, Sam? It's like it doesn't suit everybody. Some people just aren't comfortable with spending $1 million on an investment property. Soon it will become the norm. Like investment properties now, they're not $500,000 anymore. Like they're really 1-bedroom apartments now. Back in the day, when I say back in the day, it's literally only like 6, 7, 8 years ago, you could buy really good investment properties for $500,000. The needle has now moved. The sweet spot's now about $750,000. And before long, what do you think the new sweet spot's going to be? It'll be $1 million.
It's going to keep moving,
right? And it's just numbers, right? You've got to understand, like over the last 100 years, property has always moved up in value. So, a property that was $100,000, say 30 years ago, was actually quite expensive at the time. But now we look at it and go, oh, $100,000's nothing, right? So, you've got to adapt to the way money works, the way property values increase. don't get put off by the numbers. Just understand, okay, well, this is the growth pattern of these particular markets.
It's all relative. So that example of 100 grand 30 years ago, the salaries were like 10 or 12 grand, 15 grand, 20 grand.
Well, it was expensive, Sam.
Yeah.
My parents' first investment property cost them, I think, 130 grand. That same property they still hold, now they built a granny flat on the back of it, is worth $1 million.
Wow. Yeah.
You know, in 30 years, I mean, they've done it hard for 30 years, but they held on to it, they never sold, and it's 10x'd. You know, like that's an amazing return. Imagine the cash on cash returns.
Massive.
You know, because they obviously leveraged that money as well. They didn't pay cash for it. So, you know, like property will always seem expensive now. Like that Bridgman Downs deal, for example, a year or two ago, that was expensive. We were like, oh, you know, we really got to dig deep and see if this is going to work. Now
it's run of the mill.
$1 million for a property, you'd have people fighting to pay that. So you know, you've just got to understand the fundamentals, understand value. We've got to remember, you know, even at $1.3 million for that Bridgman Downs property is still really good value, being 8-9 Ks from a CBD in a really prestige suburb. So there's still probably room for growth there. You know, it's going to happen.
And this long-term approach, give it a few more years and you can do it again.
Exactly. Look, we don't do things for short term, but these examples we're showing are some short-term results that have been exceptional for our clients. Let's move on. We'll jump to apartments now, right?
Yep.
We did recently some off-the-plan apartments in a suburb called Fitzroy North in Melbourne. This particular project was bought into off the plan about 18 months ago. So what we love about these apartments, we could get 1 bedrooms for about $500,000. And we got a number of clients into these 1-bedders. We love 1-bedders because the yields are so strong. You can get like the 5%. So it's positive cash flow. But what we really what we really loved about these apartments is that on settlement, because the contract was signed more than 12 months ago, the valuers that go in value the property at what it actually should be valued at rather than on contract price. So we've got valuations coming back in at $575.
Wow.
So these clients, including myself, bought into this project with a $50,000 deposit, but essentially turned that $50,000 into $125,000 because of that $75,000 uplift. And that was the reason why we love off the plan so much in this case is because there was no holding costs. They put a 10% deposit down and then just sat back and waited.
Sort of like having a term deposit, but the term deposit's a property.
Exactly.
It's going to pay you ridiculous money.
Exactly. So the fundamentals really stacked up on this. It was a sort of a really good location. So for our listeners that don't know Fitzroy North, it's like the Surrey Hills of Melbourne. Vacancy rate's super low. There's hardly any new projects getting launched in that area. Very, very sort of tightly held suburb. Median house price like 1.5, 1.6 million. So very, very strong blue chip location.
Hence why you have clients in there, right? That's why it's performing.
It's stacked up, Sam, you know. So the clients that, and myself are extremely happy with that purchase because, you know, like to do that off the plan is, you know, it doesn't happen very often, hence the reason why you've got to be really careful with buying off the plan. But great product, we'd love to do that again. And look, that strategy's out there for everyone. And I think the biggest key here is patience. Let the market do the heavy lifting and then 18 months, 24 months will come around. It's going to come around anyway.
It's not about time in the game. It's not timing it. It's about time
in the game. Yeah, so just committing to it.
That strategy off the plan, I've seen it done many times now through your clients and myself as well. So there's really a lot of upside to it. In terms of when we deal with clients and when you're assessing who might be suitable, who did you see mostly moving into those types of strategies?
We did a lot of SMSFs, and we did that off the back of myself doing my own SMSF and using myself as an example of something for people to consider. And the reason being is because in an SMSF you have, or in a super fund, you just have funds sitting there which you don't normally use. And our clients thought, oh, well, if I transfer it into an SMSF, self-managed super fund, what I can do is use the fund as a deposit, right? And because they only needed to use, say, 50 grand, it gave them time to contribute more money to the SMSF to build up a bigger deposit for settlement and to pay for stamp duty and fees. We also found clients like first-time investors who, sometimes we get people coming to us and going, Zah, I've only got 50 grand, like, what can I do? And unfortunately, those people can't really do that much. So what we like to do is get them on an off-the-plan strategy. The longer, the better. So let's say a 24-month plan where they go, okay, you put your 10% deposit in now, and then what we do is we just wait for this thing to grow in value, and while we're waiting, you go off and pump more money into your savings. So it gives people now a target to work towards. So we reverse engineer it. We find out, okay, on settlement, how much money do you need? We reverse engineer it from there and go, okay, this is how much money you need to be putting away every month, right? And people love that because they've got a target in front of them. And this is what we're talking about, setting goals, and it's really setting a target for yourself to work towards. When you don't have a target to work towards, you're sort of just operating aimlessly day to day. So that's what a lot of people love about engaging us, because they get put on the 10-year acquisition strategy and they go, okay, now I've got something to work towards. It's exciting.
Not only that, it's custom. So the beauty of those two examples, we have another one to come, but those two examples show that the range of clients that we can assist is someone with nothing and someone with a portfolio. So
there's something for everyone, Sam. We had someone come in the other day and they only had 30 grand. And we were like, man, we're really cornered here. And we were able to go to the developer and negotiate a 5% deposit now on a $500,000 property, which is 25 grand, another 5% in 6 months, and also half price stamp duty.
Wow.
So like that really suited that client because they were like scraping the bottom of the barrel. But there's a solution, right? Like for as little as 25, 30 grand, you can still make something happen. But don't think that that 25 grand is all you need. You're not going to need to now hustle for the next 24 months. But people need that direction. People need that plan. And it's worked, right?
Solution
Our
for everyone.
clients love it. Let's finish on a townhouse example. So we did these townhouses in Wynnum West. Funny story. We had a client buy these off the plan, and they bought it for $650,000, and it came time for settlement, and they wanted to pull out for their own personal reasons, right? And I did everything I could to save the deal, not because like I want to get paid or anything like that. It's more so because they were leaving a lot of equity on the table.
How much are we talking?
Okay, so when I went back to the developer, I said to the developer, hey, these clients no longer want to go through with the purchase. Do you think it would be all right if you refund their 10% deposit, which is $65,000? Now, in contract, they can do whatever they want with the 10% deposit if the buyer decides not to go through with the purchase. So in contract, the buyer forfeits the deposit.
So technically, that money could be lost.
Exactly, and these clients were actually happy to lose the money.
What?
They just didn't want to go through the purchase. They didn't want to get the loan. They were scared of interest rates, all of those sort of things, right? Anyway, they had their own personal reasons, so I had to respect that. So I had a duty of care to try and claw back as much for them as possible because they are my clients, right? So I did go to the developer and I said, look, cap in hand, can you please help us out? Our clients no longer want to purchase, but we really would appreciate it if you could give the deposit back. 65 grand, right? And the developer goes, yeah, no worries, we'll give it back. Too easy.
Wow.
And I was like, why was that so easy?
Doesn't make sense.
Yeah, because the contract states that you can keep that deposit.
It's not usually how they would operate either.
So I asked them, I go, what do you plan on doing with the property now? They said, it's fine, we'll relist it, Zah. It's cool. And I said, out of curiosity, how much are you going to relist the property for? And I got this in writing too. $965,000.
$965.
Over $300,000 more than what my clients purchased it for.
So upon signing to own that property, they would have been up
$300,000.
$300,000, but they didn't do it.
They didn't do it.
My God.
We describe that in our industry as heartbreaking. Like, I was so sad that we couldn't make that work for the client because
You achieved the result.
300 exactly.
You made
They
the
walked
money.
into my office. They walked into my office for my advice, and we consulted them and recommended this particular product, and we knew it was a good deal on the day, and it was madness when it was just, I was so heartbroken that, and I didn't even really care about my fee. I was more so thinking, 300 grand can change someone's life,
Massive.
right? And they left it on the table, and I was just, yeah,
No.
I have no words, right?
Yeah.
So, but in saying that, we had other clients who completed in that project. So on a positive note, we had clients up $200,000, $300,000 on an off-the-plan townhouse.
A townhouse. Townhouses aren't renowned for that kind of capital growth.
Look, it was great timing. We didn't know it was going to happen to that extent. We always knew that they would get some capital uplift. You always bank on 5 to 10%. But there, you know, we endured delays with this project. There's no stock on the market at the moment. A lot of developers are shelving projects because builders don't want to stick to fixed price contracts. So there's no townhouse stock at the moment. So, you know, the rarer something becomes, the more it goes up in value.
Yeah.
And then obviously time in the market. You know, it was just a perfect storm for those investors.
It's just, I understand when you say it's heartbreaking because you've done everything you can to help this client that came to you, and what's that, 500% increase in their money?
I
It's
cried
like
myself to sleep, Sam. Like, it was because I'm very passionate about what I do, and I take pride in what I do, and I love providing that result more than the fee that I charge, right? Because it just really shows my value. And it was just one of those things where it was probably one of the most bizarre moments that ever occurred this year, because it was just like, you've come to me to make money and build wealth through property, and I've just killed it for you. Like, some people don't even make that money on a development.
Would that be the biggest return in a residential type?
In a townhouse, yes.
In a townhouse.
In a townhouse, that would have to be the biggest return. And because this townhouse was located in Queensland, you can't nominate contracts out. So
Stuck.
you got to terminate.
You can't do anything creative.
No. No. So if it was in Victoria, I could have bought, like, I would have bought that contract 10 times over, but I couldn't. And the developers, they kind of welcome stuff like this because they're 300 grand up, right?
Yeah.
And I'm sure it happened with other people in their project, and they were really good to me. They said to me, they go, Zah, are you sure that your clients want to pull out, because we're going to write in writing that we're relisting this for $965, and because they did buy it at $650. So they were really good about it. They weren't sharks. They said, yep, no worries.
They gave you enough time to consider
and like, they actually gave me a week, and every day they go, are you sure? Are you sure? I'm going, guys, like,
it's done. Can't do it.
Yeah, I can't. They just don't want to do it. They've mentally left the deal, right? But anyway, they're great. They're great deals, right? You know, like, overall, we killed it for our clients. We made, you know, on something as small as a one-bedroom apartment, $75,000, $80,000, a couple of $100 grand, or even $300 grand on the house and land, and a couple of $100 grand on a townhouse. Like, to do that using those things as vehicles, I actually don't know how you could make money better anywhere else with such little funds.
From an investment point of view, no, you can't.
Like, it's 100% return on your money, if not more, right? So whatever deposit these people have put in, they've essentially doubled their money or tripled their money. And to do that in anything else, like, it's very difficult.
You can go to Star City, or you can risk it by going to jail doing shonky things, but not with legit money. Like, get it, in a legit way, you cannot beat this. Shares won't do it. Crypto, you might be up, but then you're going to lose your house the next day. So there's no other way you can do that. No.
And let's bring it back to the cash flow. Every single one of these is achieving 5%.
Yeah. So not only are you getting them that equity to go again, they're going to wash their own face, which in that investment space, when you're dealing with property, is crucial. Because if you don't have that, you're going to be looked at worse by the banks. So no, it's each project that you've just mentioned has really served our clients well, which is amazing.
And we can do this again in 2023, and that's what we're saying. Like we want people to come and not be afraid of the uncertainty. This is the time to sort of get into stuff like this. There are projects that are getting launched, and it's a bit of a quieter time, so you've got less competition, you've got time to think. So I think 2023 is going to be really a good year to sort of buy this sort of stuff, alongside good advice from people like us. Let's move on now.
No problem.
High interest rate environment.
Okay, so that sort of came up on us in 2022. It's going to be around in 2023 as well.
Well, we've had 7 rate rises, I think. So it's been about 7 months. They think that there'll probably be a couple more. I don't know how much more they can actually raise them by. We're getting to probably the top.
A lot of people saying that.
Yeah.
It's getting to the peak of the rate rise. What's interesting is there's no RBA meeting in January because of the holidays, I think. So the next time they look at everything is going to be February. So it's 2 months, sort of 2 months away, or a month and we're missing one decision anyway. So that's going to be interesting to see what they assess over the Christmas time and the spending and the opening of the new year and the positivity, negativity in the market. So we'll see. I think the high interest rate, we consider this high now, but I think if you look in history, it's quite an average rate, but it is higher than we were used to. So I think it's likely to plateau and just be the norm, the new norm. So, with the same activity we did last year with clients in that environment, which all those properties were acquired in that sort of environment, you can still make money. You can still
rates
invest
are still,
well.
when you think about it, rates are still low. Like
exactly,
I bought at, a lot of our, loyal fans will remember us talking about when I first bought, but it was like 10%. So like now you're getting interest rates of 5-6%. It's still not that bad, right? But also we've got to remember the RBA are they're trying to set themselves up for when they need to cut rates again. They can't just bring it up to a level and then go, okay, our job's done. Like obviously they're trying to fight inflation and all of this sort of thing. And it'll happen, right? Like I think early next year we'll start seeing some of this inflation sort of dampen down because there's less money in the economy and, there's going to be a down period, 100%. But it won't last forever, and it will become the norm where the RBA will meet every month and they won't raise rates, right? They may not drop them, but they're not going to raise them forever. It's just not going to occur. But they are raising it because they're trying to do something with the amount of money in the economy floating around.
They're trying to slow it down. That's what it's for. That's what the rate rises are for. It's the RBA and the government's way of slowing down growth. So it means we're growing too much, and it's fighting inflation as well, but there's too much money circulating. They need to calm it down. It's sort of, once that plateau factors into, I think, people's mindsets in there, because right now, because it is on the upward, I think people are scared. Obviously, it creates fear and all that kind of thing. But once they drop off a little and stay in a maintaining sort of level, that's when people get confidence again.
Well, I think when they stop raising them, right?
Yeah,
so they might not drop them, but they might not raise them for 3 months. And then people will go, oh, well, this is it. All right, I'm going to budget for 6%.
That's right.
I'm going to budget for 6.5%, whatever it ends up being.
Right now you can't do that because you don't know what's going to happen.
There's so much uncertainty, and we get it. We get the frustration, we get the fear and all of that sort of thing. But, at the end of the day, when there's the most uncertainty, that's the time to get in because a lot of people aren't getting in. And what I'm loving about this market at the moment is there's opportunity, and you're able to put deals together, and you're not going to get gazumped, right, by another buyer because there's a bit of room to move in the market at the moment. So it gives us time to actually put a deal together and think about it and go over the cash flow and calculate the tax breaks and all of that sort of thing, and give the client confidence that they're making the right move.
You can breathe a little now. Before, if you didn't sign the contract that day, it was gone, right?
Exactly.
I remember seeing you had to get contracts signed within 2 days.
It's madness, and you don't want to operate in an environment like that all the time because it's too cutthroat, right? It's not sustainable to operate in a forever boom. So I think it's good that this thing is cooling it down. It's making property a little bit more affordable, and a lot of people are going, yeah, but the repayments are high and all of that sort of thing. But they've got to do something to cool it down a bit, because you can't sustain 15% growth year on year. It's just it's not going to be good for us.
Yeah, there's limited levers. The RBA is one of them, and that's just what they're doing. With respect to, say, investments, the high interest rate environment that we're in and likely to be in, or that sort of higher rate that we're at now, that doesn't affect us so much, the investor, compared to the homeowner. And I guess the way you can think about it is, if you can't borrow the money, like people aren't buying the house, they have to rent. So what that means is the rates going up forces people to, say, rent somewhere, which will create demand for your property. And you don't want to take advantage of people when they can't buy the house, but it's going to create more demand for that property to rent in. So your rents will help cover that cost of the interest rate.
Yeah, and rents going up. They're going up everywhere in the country. Yeah. But Grant Cardone said something interesting the other day. He said, what will happen is when these house prices come down, he's obviously talking about the United States, right? As these house prices come down in decline, what will happen is the yield will catch up on the house, right? Okay, so that particular asset will then become attractive for the investor. So then the investor will pile in and grab that asset, which will then push its value up or protect it from any further decline, because that yield now, as rents go up, are starting to catch up to that capital growth or the price of the property. So there can't be a crash, right? Because it's not like we're producing forever stock here. We actually have a lack of supply. So yes, it will hurt the homeowner who has to jump out of the mortgage and relinquish that and then go, okay, now I've got to go rent, which will then push up rents. But then that property, as it goes down in value, it will meet.
It'll become a deal.
That balance, right, for an investor. And I think, we'll touch on this later on. The investors sort of still need to find a home for their money.
Exactly. So it's opportunities coming.
Yeah.
That's pretty much what's being said. All right, we'll go on to the next
surging
one.
rents. So we just touched on this. So the forecast for Sydney next year is I think it's like 12 to 16%.
Is it?
Yeah. The Melbourne is about 15%, so slightly behind Sydney, and Brisbane is around, I think, 10%.
I think that could be linked to, because leases are usually a year. A lot of these leases will be coming up for renewal. So that's probably where it's going to be bumped up to cater for the interest rate.
It has to. So you've got to remember, it's like money is a cost of good. So as a landlord, you are providing accommodation, and part of your expense is the cost of money. So as that goes up, just like in any business, like as a builder would have to charge more for materials because it's gone up in value, it's the same as a landlord with rents. So they have to charge more. So a lot of these 6-12-month leases are coming up, and we're noticing a lot of people going for rentals, and it's there are 100 applicants in front of them and all of that sort of thing. It's because there's no stock. So what landlords are doing is going, okay, well, the demand's there, so I can put the rents up. Now, if your property manager is if she's worth her weight or his weight, they will push rents up for you. They will suggest, hey, let's do a rent review. If they don't, that's probably a red flag that they're probably not the best property managers to engage. But really, rents are going up. They're going up across the nation. Obviously, they're going up more in the capital cities because we're getting immigration, and obviously there's more demand because of the infrastructure and people want to be in the cities. But yeah, those projections are pretty crazy, So something that was worth, $1,000 is probably going to be worth, $11.50, next year. So that's where the opportunity is, and I think the way the media portrays it is like obviously a rental crisis, and we've got this housing shortage, but they don't say, okay, well, we need more investors, right? If we had more investors providing this, then maybe, you know, it'll help out because, but which is good for us investors that not everybody's in it. But when you think about it, that really is the solution because we got to remember as a nation, the real estate market, as in private residential market, is worth about 9.5 trillion.
Massive.
20% of that is debt. The 80% is what, Sam?
Equity.
So we're sitting on a lot of equity as a nation, right? I think the average net worth of an Australian is quite high, right? So we have a lot of lazy equity and a lazy net worth sitting there, not really doing much. So it's up to us as investors to provide this solution for society. But at the same time, it's up to us investors to do it so we can make a return. And those returns are being seen in rents. And we just have to look at some of the big financial institutions. Some of the big players in the industry are now turning to whole build to rent models.
I've seen them in Sydney.
Right? It's new to Australia. They're starting to do it in Melbourne and, like you said, in Sydney. Why are they doing it? Because they see the opportunity that we're turning into this nation of renters because it's the only option for shelter. The immigrants come here. They've got to rent, right? The people who sell their homes here because they can't afford the repayments, they've got to rent. So these guys are coming, like we're talking big players like Blackstones and those guys coming over to go, hey, we're going to build a 400 unit apartment complex, but we're not selling them. We're going to rent them. So if you've got big institutions doing that, I think in America, they've got Blackstone's buying single family homes. JP Morgan, they're buying single family homes and they're building them. They're building communities to hold on to so they can rent them out. So if the big players are doing this, then that means we should be doing it.
I've heard actually in Europe as well, Germany, I think there was a big riot or pushback because I think it was a pension fund or a hedge fund was acquiring all the rental property stock in one of the cities and no one could buy anything. So they were chasing the yield as well. So yeah, I think...
well, what's money in the bank doing for you, Sam?
It's nothing.
Even with these interest rate rises, what is it doing?
No, agree. It's
nothing.
Nothing.
These people that whinge and whine about these rate rises and how they're not going to be able to service these mortgages, yeah, I get it if you've bought the home, but we're telling you not to buy the home. We're telling you to buy the investment. And what I've been really surprised with is we've been doing these cash flow analyses for clients lately on these new purchases that they've been buying for investments. And I really expected them to be out of whack, like they'd be in really, really high negative cash flow. But it hasn't been too bad, right? Like because the higher interest is attracting a bigger tax refund and it just all balances out. So it really is the way to go in any environment, I feel, is to be an investor because if you buy the right product, you can sort of weather any storm.
So if it's on the agenda to get into the market, if it's not the home, just buy an investment property. That's what you got to do.
Well, we're seeing it time and time again, even with the rate rises, they're coming out neutrally geared. So it's not costing you anything. Your money's being put to work. You're buying at a discount over the next 6 to 12 months. It just makes sense. It's a no-brainer, right? But we listen to the news, we read the media, we believe in the doom and gloom, and you know what? Like, it puts us all off.
And there's a point to it. We become a consumer. We
Yeah.
buy the home, we don't do this investing, and we're stuck with a bank slave. Anyway, that's another story.
All right, number 4.
Number 4, lack of supply. Okay, so I guess that's an external environment thing occurring pretty much Australia-wide, we'll say worldwide. Throughout the last couple of years, everything has put a spanner in the works. Building approvals are down, developers are going down.
Building approvals were already down prior to COVID.
They were already down.
They were already down.
Okay.
So there was a shortage in projects that were going to get delivered prior to COVID. Because what happened when APRA came in and pulled up the handbrake on lending, a lot of developers were like, well, let's just land bank sites, right? And that's happening again now because they can't make them stack up. Their feasibilities just aren't making it profitable. They can't get their I guess 15-20% margin. So what's the point in doing it for nothing? Because developers, they're in it to make money.
They're in business. Yeah.
So we're seeing a lack of approvals, a lack of stock that's getting delivered to market. There's just nothing there, Sam. So what's happening is whatever that is there is becoming a highly prized commodity. So it's even hard for us to put deals together where finding registered land and all of that sort of thing. And this is just putting pressure on pricing. So I don't see us going through a crash, right? Yeah, someone who's bought the $2.5-3 million home in a really good suburb with a $2.5 million mortgage, obviously those people are going to feel the pinch and they're going to get out of that stuff. But the stuff in that sweet spot that we talk about, $500,000 to $1 million, there's a lot of value there in the right markets as long as it's positively geared. Hey, it's a no-brainer.
The affordable markets, I think, is where most of the people play. So there's more people in there. So that's where you're likely to be safe.
Look, we're not going to live in any of our investments, right? Like we're probably not even going to see them in person. So it's really important to get that into your head and realize that, okay, affordability is where the value is. And when it comes to investing, you want to invest for value. Don't invest in the latest hot stock or something that's overshot in price or something that's too volatile and too expensive. Expensive is not always the way to go.
If it sounds too good to be true, it usually is. Don't get burnt. So just stay, we say it all the time, it's boring. Sometimes it's boring.
Yeah.
Just buy the boring stuff and you'll do okay.
Yeah, do that for 10, 20 years and you'll come out on top. Let's keep moving. Number 5, immigration.
Immigration. You can sort of class this internal and external. So you got your interstate migration, that's still occurring. Still seems like Queensland's getting the bulk of the Australians moving around. So that's going to have an impact, I think, as well, moving forward. And overseas immigration seems to be pouring into Melbourne, it would seem. So that's obviously causing demand shifts across the country.
Well, Melbourne's going to overtake Sydney in terms of population.
They put that in the stat, didn't they?
Yeah, 4 to 6 years. They're thinking it's going to over. I think we're neck to neck at the moment, but I reckon they said I think 4 to 6 years it's going to overtake, which is not far away. It's amazing, but what's not so amazing is that where are these people going to live? So it's only going to put pressure on rents. It's going to put pressure on property prices. The vacancy rates are already super low. And, like you said, the bulk of immigration, they go to Melbourne probably because it's more culturally diverse. There's probably more opportunity there, maybe more family. It's more affordable. It sits 6 to 7 years behind Sydney in terms of a property market. So something that's worth $1 million here is worth 500-600 grand there. There's a lot of value there, right? So I think if you invest in Melbourne, even if it's just apartments over the next 10 years, you'll do really, really well.
I think just from an economic point of view, with immigration and people coming to the country, and just say they come to Melbourne, what does that do? It's twofold. And this is, I think, a good argument for why people should invest their money. It's increasing the supply of labour. So whatever you're doing there, there'll be like, if there's an increase in 10%, that's sort of a 10% increase of accountants potentially, engineers. So it's sort of, you're diluting yourself in the workforce, meaning you could probably not charge as much for your labour. So
there's an oversupply.
So as well as creating demand for properties that will probably go up, immigration, just its nature, it floods the supply of labour, which can pull back your wage. So just from an economics point of view, it's it can have an impact on your money, the value of your money, or your ability to make money. So you really want to be looking at that kind of stuff as well.
That's interesting. Yeah, I didn't even think of it that way.
Yeah, So they
see, the way I think of it is that we can now get more workers to do the work for us.
You can, so you can be more efficient.
Yeah.
But I think
because labour's been a big issue lately, right?
They're saying skilled labour, there's not enough and all that kind of stuff. But you have to remember. So if skilled, say in accounting, there's not much labour there. You can demand whatever you want. You can ask 140 grand. You could probably get it. But just say they bring in thousands of accountants, you're not getting 140k anymore. They're going to get guys 80k. Yeah. So That's just something to keep in mind. So, we love migrants coming here, but you just have to understand the economic impact of them coming and why you should actually put your money to work. Don't rely on your wage.
Yeah.
Because it's going to go up over time more than your wage.
Of course.
Okay.
Of course. Protect yourself. That's a very, very good point, Sam. Replacement cost. So we touched on construction, how much things are costing at the moment. I think property prices are going to be protected through the replacement cost of these items. These product lines that we're dealing with, if people are settling on them now, there's no way we can do that same deal again today, right? So, we'll give that Bridgeman Downs house and land package, for example, that we did. I think the build came in at 450 grand. That same build today will probably cost me 550. It's just, even prior to COVID, construction prices in, say, Southeast Queensland moved at an inflation rate of around 10%.
Wow.
So it's like, even before all of this construction crisis where we had this material shortage, delays, or labour shortage, it was already growing. So the replacement cost for all of these things are only going to go up, which means that it protects the existing assets that you have, which means that it's very hard to see a property crash in the future.
Yeah, and it goes back to when you invest your money, whether it's the debt component or your equity, your cash putting in, you're parking in time that money so it doesn't devalue anymore. So the debt as well. So you're getting the $900,000, your 100 grand, it's $1 million. You're freezing that in time. So in 10 years' time, when the builders are charging double their current
Which
rates,
will happen. It'll happen.
The architects' fees are now double what they used to, because everything's going up.
Sam's fees have doubled.
Accounting fees go up. But think like my parents' property, if that was bought for, say, 100 grand, that probably cost the builders, the architects, everything, $40,000 or something to do the whole house.
Yeah.
And now they're charging what, $400,000. Yeah. So 20, 30 years time. So
everything goes up.
Factoring that in, it's like you're trying to park your money to avoid this devaluing of it, which sort of comes through in the replacement cost, things going up, and the inflation.
It's going to happen. It's going to happen.
It's just a way to be smart with your excess money you have.
All right, let's move real quick. So superior assets will continue to grow. I talked to my builder about this the other day. He's very big in property. I actually look up to this guy. He does a lot of my development projects. And he said to me, he goes, Zah, like, you're never going to find a deal in what you want. So we're looking for sites, right? He goes, good sites will always command great money in any economic climate, right? And then what he's trying to say is that blue chip land is never going to go down in value. Like, it might just stay there, but it will always go up or just like hold its value. So what we have to remember is what we try and do for all of our clients, and we'll go back to those examples, they're in superior locations and they're done by, A-class builders and developers. So, you've got all your warranties and you're never ever going to have a problem with those guys. And if you do, they're going to help you fix it, right? So superior assets in great locations, you'll never lose.
So you really need a plan. You have your fundamentals you have at Luxland, which when you follow, you get those results from the apartments, townhouses and houses. So it's not just buying anything, as we always say, it's buying specific things. And you're dealing with debt, so you don't want to get it wrong. So be careful how you pick as best you can in your price bracket, and you should be fine over time.
Fundamentals, love it. All right, who wins? We touched on this. Investor or owner occupiers. Obviously, investors win in an environment like this. Owner occupiers, I'm not going to say they lose, but they hurt because the owner occupiers are liable for the mortgage repayments, where with the investors, the tenants and the taxmen pay the repayments for you.
That's right.
So there's a lot more flexibility in being an investor.
Easy to hold the investment. Buying the home, especially now, very difficult. I had a client sold his house for 1.6 million in Hornsby. He wants to live in the beaches, northern beaches. He's looking at 3.2 mil to buy a stock standard house on the beaches, and he needs 1.6 mil debt. This guy's on okay money, 200k or 180k, after tax 120. That mortgage of 1.6 that he wants to get to fund that purchase, it's going to cost him about 100 grand a year. And if we take like the tax out of his salary, he can't really do it. So buying the home now is, even with someone with a 1.6, like 50% leveraged, yes, he has to borrow 1.6 mil, but in Sydney, that's sort of like average kind of numbers. You can't freaking do it. I went through it with him. I'm like, well, you're going to be eating tuna cans. So do you want to eat tuna cans, live by the beach, or live better? So, and in that same conversation I had with him, and he's invested before. He goes, so what do I do? And I said, well,
come and see Zah.
Yeah, I was saying like, well, you've invested before. You know how property can make you money. Maybe it's not buying the home now. It's going to cost you too much money to hold and live in. So he's considering.
I couldn't think of anything worse, Sam. You know, and for our listeners that have mortgages, and you're getting hit with mortgage repayments, I feel your pain. You know, like I just can't imagine having a $2-3 million mortgage when I can just pay you know, if I'm going to pay $2,000 a week, I want to be flexible. You know what I mean? Yeah. So it's, I don't know. It's not for everyone. We've been sold on this theory that it works. You know, at the end of the day, you're now seeing that it sort of doesn't work. I mean, some people can endure it, and they're going to have to. But are you loving life?
No.
You know what I mean?
No.
Like let's not forget the maintenance and repairs on a home. You know, like when you rent, you call up the landlord or the property manager, and they come and fix it. When you own the home, you're liable for that. You've got to do all of that work. So I think factoring those costs in to owning a home on top of your mortgage repayments is really, really important. You know, if you're in a mortgage at the moment, knuckle down. It's not going to last forever, but this will be the new norm, and this is the responsibility of owning your own home.
A lot of people say when they buy the home that it's like safe, they own something, it's theirs, but it's not theirs. The bank owns it. The bank has the title.
Well, we've got to remember, like even when our parents bought their home and they took out a mortgage, the first 10, 15 years wasn't easy for them, right? They had very high interest rates themselves. You know, they weren't on the highest wages, and they had to eat tuna cans for a long time, right? So, you know, this is the tough period that a lot of our sort of younger listeners are going through as owner-occupiers. But look, we wish you luck, right? We wish you luck. But if you can, you've got some surplus money on the side, invest it.
Reach out.
Yeah, invest it. All right, number 9, long-term approach. I think having a long-term view rather than just a yearly view, you know, is really important. You know, property is a minimum 10, 15-year, 20-year plan. Look, I'm in this for pretty much forever. I don't think I'll ever sell my assets. And then when you start thinking 100 years ahead, you start not really worrying about the noise. And, you know, I think that's probably the biggest takeaway. Don't get caught up in the noise, you know, like just put it aside. I was having breakfast with a developer the other day, and he said, Zah, this strategy, it's just not rocket science. You buy a property, try and get a good deal, obviously. Buy a property for 500-600 grand and just sit on it. Don't touch it. Keep it for a minimum of 10 years. And if you bought in the right location, it will double in value.
Buy and wait. It's sort of like the lazy guy's way to wealth, really. You don't have to go into business.
Easy.
You don't have to take big risk. It is risky taking an action, but all risk, there's risk in everything.
But you can mitigate that risk by listening to this podcast.
Correct. But like it's yeah, I don't know. But
more people need to be doing it. More people need to be doing it. So take a long-term approach. I think it'll pull you out of the bad times. You'll start to ignore what you see on the news and the media and all of that sort of thing, and you'll start living a more prosperous life because you'll know that you've made a decision that's going to be returned more so in 10, 15, 20 years' time rather than in the next 2-3 months.
I think we got caught up with the whole things are going up 20%.
Yep.
You buy this, it's worth 200 grand more next year, all that kind of stuff. That's not normal.
No, it's not normal. It's not going to happen for a long time.
You're lucky if you got in.
Yeah, you want to be shooting for 5, 6, 7%, you know what I mean? And you want to do that over a 10-year period.
That's doubling your money. 7% a year is doubling your money.
Yeah.
So, and that's conservative. That's the conservative numbers they project out. That happens in property, doubling every 10 years. So we just have to stop being impatient.
Yeah. And as a younger generation, I think we're getting more and more impatient, right? Yeah. But I think, you know, the biggest takeaway, I think, for this year is the opportunity for next year.
Yep.
And that's just seeing now a window of 6 to 12 months where I think there's going to be really, really good buying opportunities. There's going to be less competition. you've actually got time to think now
Yep.
to put a deal together. I know money's expensive from the bank, and you know people are finding it hard to put money together to save. But if you do have equity, if you do have savings, I think next year is the year to be putting it to work. A lot of people will be saying, "Oh, you say that every year," but I think, yeah, well, if you can set yourself up for the next boom, in the next 2-3 years, you're going to be really, really happy that you're in assets and not looking for assets at that point in time.
For the listeners who saw the first part of the podcast about the types of assets, where do you see the biggest opportunities? What types?
Apartments,
Purely
on affordability.
Okay.
Because if you look at that $500,000 to say $700,000 price point, you're not going to really buy
Yep.
a house and land in a superior location. You're not going to buy a townhouse at the moment because there's none available, right? And if it is available, it's way overpriced and you're paying too much. I think the deals are in apartments, and a lot of people are like, "Oh, but I don't like apartments," but it's affordable.
Make you money.
It's affordable. Like houses have gone through the roof from the pandemic, and apartments have stayed down here. They're going to have to catch up.
Yeah.
They've historically always caught up. So I feel like apartments in really blue chip locations, in selective markets, are in very short supply and also very, very undervalued. So if we look at apartments in Melbourne, for example, the equivalent, in an equivalent suburb here, you know, something here would probably cost $1 million. In Melbourne, in an equivalent suburb, it's probably going to cost 500-600 grand, right? And you got to remember, those same people live in those suburbs as, say, the Bondis.
Same demographics.
So, you know, if you could turn back time 6-7 years ago, would you have bought that $1 million apartment that's worth $1 million now for 607 years ago? Yeah, you would have, right? So I think that's where the biggest opportunity is. And
Amazing.
Affordability. I mean, people want affordable products. They want to rent them, they want to buy them, they want to live in them. There's always going to be demand.
There's demand. So that's where you should put your money.
Yeah, yeah.
Awesome.
All right. There's to another year, Sam. Thank you for a great year. Thank you to our listeners, our supportive and loyal listeners, for another great year. We apologize for delaying our podcast, but we've made a promise to ourselves and to you guys that we'll do this more regularly next year. We want to wish you all a very happy and safe new year and all the best for 2023. See you guys.